There's a pattern in history, a 7-stage blueprint for how economies collapse. It doesn't start with bombs or invasions. It starts with a party, and it ends in ruin. We saw it in 1929. We saw it leading up to 2008. We saw it in the brutal economic implosion of Greece. And right now, the United States is following that exact same pattern. The math is undeniable. This should concern you, because the U.S. has already progressed through the first 4 stages. We're not approaching the pattern. We are deep inside it. And the evidence suggests we are now in stage 5, the stage where the financial crisis becomes real for everyday people. The stage where retirements get wiped out. This is the story of that pattern. It's the story of how a country that controls the money of the world can still go broke. You need to understand what this looks like in practice. Number 1. The illusion of wealth, the boom. Every collapse begins with a great party. Stage 1 is the illusion of wealth, a period of intoxicating optimism where everyone believes the good times will never end. The economy seems unstoppable, asset prices only go up, and borrowing money is cheap and easy. Everyone feels like a financial genius. Think of the Roaring '20s. After the turmoil of World War I, America entered a new era of prosperity. New technologies like the automobile and radio were changing the world, and the stock market became a national obsession. People borrowed money like never before to speculate, a practice called buying on margin. It was a nationwide frenzy, built on the belief that the market could only go up. This was the illusion of wealth in its purest form. Now, fast forward to the years before 2008. From 2002 to 2007, we saw it again. This time, the drug of choice was real estate. The belief that housing prices never fall was gospel. Lenders handed out loans to almost anyone, often with no down payment and no proof of income, the infamous ninja loans. House flipping became a national pastime. On paper, household wealth was exploding, but it was a fragile, debt-fueled prosperity. It was an illusion. In both cases, the boom was driven not by sustainable value, but by a dangerous expansion of credit and speculative fever. It's the hypnotic first stage that makes the fall so devastating. Number 2. The first tremor. The peak and cracks appear. After the party comes the first hint of a hangover. Stage 2 is the first tremor. The upward momentum slows. Asset prices hit a plateau, and the first cracks in the foundation appear. These are not catastrophic events, not yet. They are small shocks, often dismissed by the majority, but they are a clear signal that psychology is shifting from greed to fear. Before the 1929 crash, the market became volatile. After years of explosive growth, there were sharp sell-offs that were quickly bought back up. Prominent economists famously declared stocks had reached a permanently high plateau. But beneath the surface, the smart money was getting nervous. Industrial production had started to decline. Construction was slowing. The real economy could no longer support the sky-high valuations. The same pattern played out before 2008. The housing market peaked in 2006. By 2007, the tremors began. The first major sign was the collapse of 2 hedge funds at Bear Stearns in June 2007, funds heavily invested in subprime mortgages. When they imploded, it was a warning that the assets underpinning the housing boom were toxic. Throughout late 2007, mortgage defaults began to tick up. Yet, the official narrative was one of containment. Officials insisted the broader economy was fine. But the tremors were getting stronger. It was the moment the orchestra keeps playing, even as the ship has begun to take on water. Number 3. The denial. The dead cat bounce. Human psychology is a powerful force. No stage demonstrates this more than stage 3, the denial. After the first tremors, the system doesn't immediately collapse. Instead, there's often a brief, deceptive recovery. It's known as the dead cat bounce, the idea that even a dead cat will bounce if it falls from a great height. It's a sucker's rally before the real pain begins. The narrative is controlled by wishful thinking. Officials rush to reassure the public. The worst is behind us. The fundamentals are strong. They have every incentive to prevent a panic. We saw this after the initial shock of Black Thursday in October 1929. The next day, there was a rally. Top bankers pooled their resources to publicly buy stock, showing their confidence. President Herbert Hoover himself stated that the fundamental business of the country is on a sound and prosperous basis. This lured many investors back in, believing they were buying the dip. They had no idea the Black Tuesday was just around the corner. The 2008 playbook was eerily similar. After the Bear Stearns hedge funds collapsed and the bank itself was rescued in March 2008, there was a period of calm. The stock market rallied. The Fed had started cutting interest rates. Many believed the aggressive policy actions had worked. The term soft landing was everywhere. This stage is a psychological trap. It preys on our desire for things to go back to normal. But the underlying problems, the excessive debt, the bad investments, haven't gone away. They are festering. Number 4. The avalanche, the crash. Stage 4 is the moment everyone remembers. The avalanche. The denial has shattered, and faith evaporates in an instant. This is the crash. It is swift and brutal. Panic replaces greed, and everyone rushes for the exit at once. On October 29, 1929, Black Tuesday, the stock market collapsed. 16 million shares were traded. Fortunes built over a decade were wiped out in hours. The avalanche had begun, and it would cascade through the entire economy, triggering bank failures and business closures that marked the true beginning of the Great Depression. In 2008, the avalanche was triggered by a single event, the bankruptcy of Lehman Brothers on September 15th. The market assumed the government would rescue Lehman as it had Bear Stearns. When they didn't, it was a signal that no one was safe. Credit markets, the circulatory system of the economy, froze solid. Banks stopped lending to each other. This wasn't just a stock market crash. It was a heart attack of the entire financial system. For Greece, the avalanche was a slow-motion collapse that began in late 2009. The world finally understood the true scale of Greece's doctored financial books. Investor confidence vanished. The interest rates Greece had to pay on its debt skyrocketed, triggering a sovereign debt crisis. The government was forced to seek a bailout, but the price was devastating austerity. This stage is defined by a complete loss of confidence. The wealth that people thought they had is exposed for what it was, an illusion built on unsustainable debt. Number 5. The unraveling, the economic fallout and policy response. And this brings us to today. Stage 5. The unraveling. If the avalanche is the crash, the unraveling is the grim, grinding aftermath where the financial crisis bleeds onto Main Street. It's defined by rising unemployment, failing businesses, and a painful contraction of the real economy. It is also defined by the desperate responses from central banks as they try to prevent a total collapse. The evidence is mounting that this is exactly where the United States finds itself. Let's look at the data. The first symptom: stubborn, systemic inflation. The transitory inflation. Narrative is dead. As of late 2025, inflation remains persistently above the Federal Reserve's target. The annual inflation rate for September 2025 was 3.0%, up from 2.9% in August. Forecasts suggest it could remain elevated, with some analysts expecting it to reach above 3% by the end of 2025. This isn't hyperinflation, but it's persistent enough to force the Fed into a terrible dilemma. It has been fighting this inflation by raising interest rates, but every rate hike is a hammer blow to an economy built on cheap debt. The second symptom: a debt burden of historic proportions. The United States is drowning in debt. Projections from the Congressional Budget Office show federal debt held by the public is on track to surpass its all-time high relative to the economy by 2029. More recent analyses suggest debt could reach 122% of GDP by 2035. Let's put that in a terrifying historical context. When the Greek debt crisis was triggered in 2009, their debt-to-GDP ratio was approximately 127%. The United States is operating in the same red zone that triggered a decade-long depression in another developed nation. This isn't a future problem, it's a clear and present danger. The third symptom: cracks in the labor market. The strong labor market was the last line of defense. That line is now breaking. The unemployment rate has been ticking up, hitting 4.4% in September 2025, its highest level since October 2021. More concerning are the details. U.S. employers announced 153,074 planned job cuts in October 2025, a 183% increase from the previous month and the highest October total in over 20 years. Through October, employers have announced 1.1 million job cuts, a 65% increase from the same period last year. This is the classic signal of the unraveling. Financial weakness is now costing people their livelihoods. The fourth symptom: the consumer is tapping out. The American consumer is the engine of the economy. That engine is running on fumes. Total household debt surged to a record $18.59 trillion in the third quarter of 2025. Credit card debt specifically has exploded, hitting an all-time high of $1.23 trillion. Delinquency rates, people falling behind on payments, are spiking. The share of credit card balances in serious delinquency is at its highest level since 2010. The consumer is financially exhausted. The final symptom: the policy trap. This is the hallmark of Stage 5. Policymakers are trapped. If they keep interest rates high to fight inflation, they risk crashing the housing market and making the government's debt unserviceable. But if they cut rates to save the economy, they risk letting inflation run wild. And we are now seeing them flinch. After a period of aggressive hikes, the Fed has pivoted, cutting rates in September and October of 2025 to a range of 3.75–4.0%. This is a classic Stage 5 move, a desperate attempt to stimulate a debt-saturated system that no longer responds. It's like giving another drink to an alcoholic. It might delay the pain, but it guarantees the eventual outcome will be far worse. This combination of factors is the undeniable signature of Stage 5. It is unraveling. And it is during this stage that the retirement wipeout becomes a reality. The statistics are already horrifying. The median retirement savings for households aged 55–64 is just $185,000. This is happening right now in Stage 5. If you're seeing these signs, if this analysis is opening your eyes to where we actually are in the sequence, subscribe. We are tracking these developments in real time. When we hit the next stages, you will want to understand what happened and why. Number 6. The Great Deception: Currency Devaluation and Capital Controls. If Stage 5 is the grinding pain of economic contraction, Stage 6 is where authorities break the social contract. This is the Great Deception. When a government has exhausted all conventional tools, when the debt is too large to ever be repaid with sound money, they turn to the one tool they have left: the printing press. Stage 6 is fundamentally about currency devaluation. Unable to pay their debts honestly, they choose to pay them dishonestly, with newly created currency that has less and less purchasing power. It is a stealth default. Your Social Security check might arrive, but the dollars you receive will buy significantly less. It is a massive, hidden tax on anyone who saves. Alongside this, Stage 6 often sees capital controls. This is the government building a financial Berlin Wall. When people lose faith in their currency, they try to get their money out. Capital controls are designed to stop this. We saw this in Greece. The government shut down the banks and imposed strict limits on cash withdrawals. They had to trap people's money inside the failing system to prevent a total bank run. It's a move of pure desperation, the financial equivalent of locking the fire exits in a burning theater. For the United States, entering Stage 6 would mean the Fed has completely given up on fighting inflation and has chosen to monetize the government's gargantuan debt. It is the stage where the mask comes off. Number 7. The final reckoning, the reset. This is the end of the line. Stage 7 is the final reckoning, the brutal, chaotic conclusion. The currency has been destroyed, the financial system has broken down, and the illusion of wealth is replaced by widespread poverty. This is the reset. In this stage, the monetary system as it was known ceases to function. The currency may become worthless due to hyperinflation. Barter can return. Economic activity grinds to a halt because the fundamental trust required for a complex economy has been obliterated. History is filled with these resets. The Weimar Republic in Germany in the 1920s saw such extreme hyperinflation that people used wheelbarrows of cash to buy bread. The currency was destroyed, paving the way for a radical and ultimately catastrophic political reset. Stage 7 is where the ultimate wealth transfer occurs. Any wealth held in paper assets denominated in the collapsing currency, cash, bonds, stocks, is wiped out. Wealth is transferred to those holding hard assets, gold, productive land, real estate, without debt. It is a harsh process that strips wealth from the unprepared. Following the collapse, a new system is introduced, a new currency, sometimes backed by gold to restore confidence. But the transition is never smooth. It's often accompanied by profound political and social upheaval. Reaching Stage 7 means the leaders and institutions we trusted have failed completely. So let's pull it all together. The 7-stage blueprint of economic collapse. Stage 1, the illusion of wealth. Stage 2, the first tremor. Stage 3, the denial. Stage 4, the avalanche. Stage 5, the unraveling. Stage 6, the great deception. And Stage 7, the final reckoning. The central argument is that the United States in late 2025 is exhibiting all the classic symptoms of Stage 5. The stubborn inflation, the mountain of government and consumer debt that has reached critical levels, the weakening of the labor market, and a central bank caught in the classic policy trap, now pivoting to cutting rates in a desperate attempt to keep the system afloat. This isn't about fear. It's about pattern recognition. The promise of a secure retirement is under direct threat from the economic forces of Stage 5. This is the retirement wipeout in action. The purpose of this analysis is not to cause panic, but to foster preparation. Preparation begins with knowledge, doing your own research, reducing personal debt, and understanding what a true store of value is in a world of financial uncertainty. The path through the next few years will be challenging, but by understanding the historical script, you're no longer a passive spectator. You can see the stage for what it is and begin to make decisions that protect you and your family. If this deep dive has been valuable, make sure you are subscribed. We will continue to track this 7-stage cycle and provide you with the information you need. The answers are not in the future. They're written in the past. I'll show you where to look.